Hi, and welcome to Macro Wednesday, where we talk macro and try to make sense of markets that, might have made a little bit of sense today. I'm your host, Steven Van Metre, and thanks for joining me today. I've got a great episode lined up, and today's episode is about the bond launch is not canceled. It's just postponed. I know a lot of people kind of were worried, it got rejected. It's there. The thesis is blown. Just so you know, you can't take a multi-year thesis and break it in one day. I mean, there's a reason it's a macro thesis. Unfortunately, a lot of people these days have attention investment disorder, where macro for them is maybe a week or a few trading days. But I live in a multi-year world with macro. I mean, that is what macro is. And one day or 1 week, even several months, it takes a lot more than that to change it. Now, before we get into that, on Monday, I was interviewed by Tom from Palisade Radio, so I want to thank whomever introduced me to him. It was one of their followers and mine as well, so thank you very much. I believe that's coming out next week, maybe sooner. They loved it. It was a great interview, so I'm really excited about it, and I hope you enjoy that too. Today, I'm going on the Jay Bravo show, and then Friday's show will be delayed. So if you're looking for it at the normal time, it's because I'm being interviewed by Patrick Ceresna, but not Eric Townsend. Sorry. I know. Some of you really pushing for macro voices, but it is a really difficult show to get on. They've got a great list of people. Maybe someday we'll make it there. I don't expect soon, but I'm going on Market Huddle, if you're familiar with Patrick Ceresna's show on Friday. And so due to the time they record, this show will be recorded after and come out a little bit late. And I do have a date set for the big interview with the legendary Brent Johnson at the end of the month for Real Vision. So pretty excited about that. And again, thanks to all of you who helped make all of this possible, because I know you did. All right, so the whole bond thing. Now, I said on Monday, remember, there's going to be some volatility this week because of the Treasury auctions. And we had the largest 10-year auction in history today. Tomorrow we have the largest 30-year auction, and tomorrow there's no QE. So we get a break in the QE run. We do get the new schedule. I will give you my prediction now that it's going to be a repeat of the current schedule, because that's pretty much what they've done. So some of you were kind of worried for me, maybe worried for yourself, because of course this show is not trading advice, so you shouldn't be trading anything that we talk on here. But of course I know probably many of you are. And again, some nerves were struck as the market got rejected and we saw interest rates rise. And we're going to get into that when we get to the charts. And I want to explain how you can understand technical analysis, and the bond market is just a great example of that right now. But I wasn't really worried about the bond auctions at all. In fact, I expected a sell-off. I'm almost surprised it's not even more, and maybe it will be by tomorrow. I don't know. But you'll notice all the selling, or at least a majority of it, wasn't overnight trading. And that's pretty interesting, because who's usually the biggest buyer at the Treasury auctions? Foreign investors. So if you're putting bids in for this auction that you know you're going to be taking a bigger chunk of, why would you defend prices at all? In fact, what would you want if you're coming into an auction? You want prices to go down. You want yields to go up for a little bit so you can get a deal, because you know that ultimately yields are headed back down. That's what you're looking for. And no surprise. So let's go take a look at how the auction went, because some of you were asking, how do you read this? How do you know what's going on? Well, I want to show you. So you go to the Treasury Direct website, and under announcements and recent press releases, you have today's auction results, and you could scroll down, and here's the 10-year auction. And what you want to do is look for the competitive result PDF that comes out after 10 a.m., shortly after 10 a.m. Pacific, which is when the auction is. And I pulled up the PDF. And so here's the one from today, August. It's 38 billion. And how do you read this? Well, the primary dealers, these are ones we're kind of interested in, as we believe that they are going to flip their entire amount to the large commercial banks, who are then going to sell it to the Fed under the QE program. So there they are. Then you have direct bidders. These are domestic U.S. bidders. And then indirect bidders are foreign bidders. Now, the market really cares about the indirect bidder. And you can simply just take each row and divide it by the total amount auction, and you get the percentage. And that's what the market is looking at. What percent was taken by indirects? Now, I happen to have that number here in a spreadsheet, and the answer is they took 65.4%, which is pretty impressive. It's not the biggest they've ever taken, but in terms of dollar amount, it's huge. Now, the other thing the market looks at is this bid to cover ratio. It's way down here at the bottom. It says 2.41. It's the total number of bids against the offer. And this is slightly below the 6-month average, but given the size of the auction was quite a bit larger, really quite a bit larger than normal, this was actually pretty good. And you can look at this on previous auctions. So here's last month's 10-year, and you can see the 6-month average, which is this, was right around 2.62. But notice that foreign investors last month took 18.3 billion. This month, 24.8. So a big move higher. Now, in terms of what we look at with the Fed, last month, the primary dealers got 5.7 billion, which again, we presume 100% eventually gets flipped to the banks, the commercial banks, who then again sell it to the Fed under QE. They didn't get that much more, just to 7.5 trillion. So not a big increase given what's going on. And this kind of shocked people that the auction could go this well. And there's a reason why we went through that, tomato soup can example. I think it was I don't think it was, maybe it was yesterday, it was last week. Because what people don't understand about quantitative easing is the Fed is taking supply off the shelves. Every day, almost every day, they're going down the aisle of tomato soup cans, and they're taking some off. And they take all sizes, small, medium, and large, but they bias toward the smaller ones. They buy more of the shorter term notes than they do the longer term bonds. And when you understand that, if you're normally a buyer, say, of 2, 3, 5-year notes, and there's not a lot of supply, well, then you're forced out the curve. So you have to go to the 7, the 10s, and the 20s and 30s. You get pushed out. And that's exactly what I expected to happen here. And it did. Now, this is kind of interesting. I've not done this before. I've never seen anyone talk about this. But I was curious to see how much per month the Fed is buying versus how much the securities dealers are buying versus how much the Fed is buying. So I went back to July, and I calculated based on the auctions that the Fed buys, which is 2 to 10-year notes, 20 to 30-year bonds, and 5 to 30-year TIPS. And I pulled all the auction records, all the securities dealers, and they bought $71.7 billion worth of bonds. Now, do you remember how in treasuries the Fed is buying every month? Yeah, 80 billion. So that leaves an 8.23 billion shortfall that the banks have to provide to the Fed. Now, obviously, the banks don't have an infinite number of bonds, plus the banks need to maintain their reserves and all the regulatory requirements that mean they have to have more bonds on hand. So where did the banks get that 8.23 million shortfall? Well, they go to the securities dealers and say, hey, go out in the market and get us $8.23 billion worth of these things. So when you see the Fed buying at $80 billion a month, and it's below what the securities dealers are taking in, that's a positive sign. And then when we see the commercial banks buying on top of that, so any month they're buying more than 80 billion, because obviously they're feeding that over, they're buying it from the securities dealers to feed to the Fed. That means they're also buying bonds. And what I thought was pretty interesting is if we look at July to August, now we only have 2 data points to compare. We have 3-year notes and 10-year notes. Well, between July and August, there's only around, actually the dealers got 200 million less. And 10-year notes, they got, looks like $1.8 billion more. So not a lot considering what the Fed is buying. So this is pretty interesting. And when you look at the bond market, the way this works is as the Fed takes supply off, if there's not enough new supply to counteract the Fed's purchases, they continue to reduce the amount of soup cans on the shelf. Now, the market is naturally short bonds. Now, what do I mean by naturally short bonds? Well, most investors in the late stage of bull markets don't own any bonds. They own very little. So maybe they're normally a 60-40 stock bond allocation, but because stocks are going up, they've shifted to an 80-20 or 95-5 or 100% stock. So they're short. They don't own that portfolio protection they normally own. And from a speculative standpoint, speculators are betting the bond prices are going down. And so that's why when we looked at that on Monday, the net spec position of short positions on the 30-year, and it was at a record low. That's very interesting because what happens is the Fed comes in and takes all these cans off the shelf. They squeeze until what? Bond prices go up, boom, yields crash, boom, and sellers get squeezed. And when sellers get squeezed, what do? They buy bonds to cover their short positions. And guess what they have to do in an illiquid market that's really high that everyone's crammed into? They have to sell something to get the cash. What do they usually sell? Risk assets, stocks. Sometimes they'll sell gold if they need to. And when these same players are short volatility, which they are, if you're long stocks, you're short volatility, and you can also, and speculators are short volatility. Well, when you start selling stocks, volatility goes up. Well, now all of a sudden you've got to cover your vol shorts. And guess what? The thing starts to unwind as everybody chases the bond market going higher and higher. And that's how this played out in the great financial crisis and how it's setting up to play out again. Now, if we go and look at this on a chart, and I want to do that, and if we have time, we'll come back and take a look at some of the economic data this week because I am committed to keeping these shows shorter. If we do look at the chart of 30-year yields, we see that they backed up, and most of it was in overnight trading because there's this big gap higher. And looks like today was holding right under its 50-day moving average, and I suspect after tomorrow's auction, this will start to turn lower. The way we need to understand this is 1.2%, so between 1.2 and say 1.25, is what's called resistance. This is where sellers have come in and shorted or sold bonds, and they've done it once, twice, and now the third time. Now, of course, being the bond king and very bond bullish, I was hoping that this would break down here. But what we learned is the sellers, even though they're very extended in their short positions to an extreme level, they still have a willingness to short the bond market, and they did. All that means is when we take a look and zoom in and say position like TLT, what we can expect then is at some point this is going to bottom and there's some decent volume showing up in here. So when you start seeing prices or candlesticks that are moving up like these cross patterns, it says that they're trading higher than their low, they're closed higher than their lowest point of the day. And when you see volume start to pick up, that's a sign of a stopping movement. So we're kind of looking here and saying, hey, this thing is probably coming to an end pretty soon. And I expect to see more ending of that tomorrow after the 30-year auction. Now, some people, again, think, okay, your thesis got blown here. It didn't. It didn't at all. You don't break a multi-year thesis by 1 week of bonds trading down at all. See, let me explain to you how to read this, and let me use it in a football analogy, and think of this as, this is where the sellers, right? This is the seller side between these two solid purple lines where the dotted one is. This is where the sellers are at. Down here is the buyers, and in the middle, you got your 40-yard line, and then right down the middle, the 50-yard line. So let's go back over here and see what happened. The offense, the buyers, the Treasury bulls, were driving prices right into the end zone. And then there was a turnover. They didn't get across the line. The sellers took over the ball and they drove it down. They were getting some good traction down, just grinding the ball down to the 40-yard line. And the defense pushed them back, maybe a sack or something like that. And then the offense came back and said, hey, we're going to get past that 40-yard line. The defense said, no, you're not. We're going to push you back again. And then the offense said, nah, we got this. And boom, 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 some big plays across the 50-yard line, right to the goal line, and fumble. Offense so the defense, so the Bulls fumble the Treasury Bears fumble, the Bulls take over an offense, and they come out, the offense rested, and boom, 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 right back to the opponent's 40-yard line. And that defense comes in and says no, and they push him back, and the offense drives back into enemy territory. Defense says no, 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 push you back, push you back. Offense says we got this, and they drive right up into the 25-yard line, and it's grinding running plays, grinding. Everybody's looking like the defense is going to hold, and the offense pushes right through. And they're running to the goal line, just grinding play after another. They get to the goal line, and they're rejected. Goal line stand. They get to the end zone. Again, they're right there at the goal line, and they fumble the ball. The offense from the Bears takes over, drives the ball down, and big play out to the 35-yard line. Look, in order for my thesis to get blown apart, call me when the Bears break through down here. And when you understand why this is so unlikely to happen and why I wanted to share with you why or the amount of treasuries the Fed is buying versus what the securities dealers are getting, you really start to understand that the bond market the offense of the bond market is the Fed. Today we saw foreign investors, which is largely foreign central banks, playing their part, and then large commercial banks too. You've got the biggest offense. So what's really cool about this is, it didn't break out when I wanted to. You know what? What a shame. But here's what's going to happen. This is going to continue to play out because the offense, the Treasury Bulls, which are playing defense right now, have an unlimited amount of firepower relative to the defense. All they have to do is wear the defense out. And maybe this goes on for a few more weeks. Maybe it goes on for a few more months. At some point, the Treasury Bears run out of ammunition, run out of desire. The defense is gassed, and the offense will push through here, and they'll break in and have a big score, and bond prices will go up. That's how this plays out. One of the two sides wins. And this is why technical analysis is so important in the big picture and why you need to marry it with macro. Because when you understand who's on your side, who's playing offense with you, or in this case at the moment playing defense, the Treasury Bulls, you're okay. Because the longer this goes on, the more the defense gets gassed out. And sometimes there's those games where the defense is so tired, the offense is just like score, 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 score. The longer this goes, the bigger the move up. That's how it plays out. And so since we're kind of low on time and I wanted to keep these videos short, I will adorn my Bond King hat for another day because one of you, and I appreciate this, posted in the comments that, hey, that king, Jeff Gunlack, said the 10-year treasuries are going to 5 or 6%, and Steve said they were going down. Now, maybe Jeff meant 0.5 to 0.6. Nah, I'm still the king. I'll see you on Friday. The content of this video is provided as educational. Oh, wait. I forgot to tell you. Subscribe, like, we got props. They're fun. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity, business express this video that I'm going to do not reflect the Atlas Financial Advisors Inc. or Steven Van Metre Financial.